Last week, we delved into the ever-changing landscape of optimal asset allocation. The ingredients for a robust defense can evolve, just as opportunities often shift between different types of investments. Today, let's explore where we're currently seeking opportunities and consider an intriguing question. Is it better to have the best manager in the worst asset class or the worst manager in the best one? I'm Philip Petursson, Chief Investment Strategist at IG Wealth Management. Join me each week as we discuss the trends dominating the investment landscape. It's the week of September 4th, so listen on as we navigate the living market. Drawing from the wit of Quebecois comedian Yvon Deschamps, who said, "It's better to be rich and healthy than to be sick and poor," it's plainly obvious that the ideal scenario involves having the best manager overseeing the best asset class. But how significant is this advantage? Well, let's dive into the data to find out. Looking at the Morningstar data on the performance metrics for a broad range of fund managers, we analyzed the disparities in performance between managers ranked in the first quartile against those ranked in the third quartile over a 5-year period from 2018 through 2022 across multiple asset classes. Within bonds, the top-tier managers outperformed the mid-range ones by a mere 1.63%. Now, this modest gap aligns well with the lower volatility and disparity often seen in fixed income. But even in global equities, the performance disparity was approximately 2.7% between the first and third quartile manager. However, the global equity universe is a very wide field. Tactically allocating between different geographic markets within this category can yield very different outcomes. To offer a more granular view, top-performing managers in Canadian equity, so those first quartile managers, outdid their third quartile counterparts by 2.21% between 2018 and 2022. In international equities, excluding the United States, the margin narrowed to 1.9%. Meanwhile, a U.S. equity manager beat out its peers by an impressive 3.74% between the first and third quartile. These figures appear to strongly advocate selecting high-performing managers. It might seem a good idea to restructure our portfolios, swapping out lower-tier funds for those in the first quartile, but there is a slight problem with this idea. Within Canadian equities, for example, only 28% of first quartile managers in 2020 maintained their first or second quartile status over the subsequent 2 calendar years. Many actually fell into the fourth quartile. In the United States, the persistence rate was slightly better at 42% of first quartile managers repeating in the first or second quartile in the second and third year, but internationally, not a single manager sustained their top performance. And what does top performance really mean? To circle back to the question we asked at the beginning about what is really the best fund, let's consider some statistics from 2022. In that year, the fourth quartile, essentially the worst performers within the Canadian equity category, generated an average return of minus 9%. Meanwhile, the second quartile of U.S. equity funds, so not the best, but the second quartile of the top half, returned an average of negative 10%. Interestingly, a poorly performing Canadian equity manager outperformed what effectively was a decent U.S. equity manager for your portfolio, despite faring worse in peer-to-peer comparisons. What does this imply? Well, the perilous strategy of chasing star funds often results in a portfolio of underperformers. So what's the answer? Well, it may sound mundane, boring even, but the answer lies in diversification and a long-term investment approach. A balanced portfolio will each year have both winners and laggards across asset classes, and by tilting our allocation to our preferred asset classes with a forward-looking focus, we work towards the desired outcome of steady, dependable performance over time. The data shows that, ironically, chasing only the best of the past can sometimes lead to the opposite outcome. So, where are we tilting our portfolios today? Well, the answer evolves, obviously, over time. Our current focus, however, leads us to see the U.S. equity market as fully valued, when compared to the Canadian equity market or international alternatives. Now, this doesn't mean abandon U.S. stocks. That's not the case at all. But we are slightly underweight in this area relative to our longer-term strategy. It is still a significant part of our model portfolio, but not as significant as before. What about the age-old debate of stocks versus bonds? In the long run, of course, risk assets outperform. Equities tend to outperform bonds over very long periods of time. But at this moment, market conditions are leaning in favor of bonds for tactical short-term tilting, simply because of the higher yields offered. The equity risk premium, or the gap between expected returns out of equities versus the risk-free rate, is the lowest it's been in many years, if not decades. This leads to the potential for bonds to deliver equity-like returns with much less downside risk. And this is why bonds, for the first time in a long time, are a favored asset class within portfolios. In closing, asset allocation is part art and part science. But neither the art or the science should lead you to think yesterday's best strategies are a surefire recipe for tomorrow's success. I'm Philip Petursson, and this has been The Living Market. If you've enjoyed this podcast, please take a moment to rate it or share it with colleagues and friends. It will help other like-minded individuals find us. Thanks for listening.